Carbon accounting impact. In a world increasingly aware of the looming threat posed by climate change, the concept of carbon accounting emerges as a pivotal tool in the fight for environmental sustainability. At its core, carbon accounting involves measuring and managing the carbon emissions produced by individuals, organizations, and nations. This practice is not merely a bureaucratic exercise. It is a critical component of a broader strategy to mitigate climate change, enhance sustainability, and promote transparency in corporate practices. The significance of carbon accounting lies in its ability to quantify the impact of human activities on the environment. By tracking carbon emissions, companies can identify the sources of their greenhouse gas output and take informed steps to reduce their carbon footprint. For instance, a manufacturing company that conducts a thorough carbon audit may discover that a significant portion of its emissions comes from outdated machinery. Armed with this knowledge, the company can invest in more energy-efficient equipment, thereby reducing emissions while also cutting operational costs. This dual benefit illustrates how carbon accounting not only addresses environmental concerns, but also enhances economic efficiency. Moreover, carbon accounting plays a crucial role in fostering sustainability by encouraging businesses to adopt more responsible practices. As consumers become more environmentally conscious, they seek out products and services from companies that demonstrate a commitment to sustainability. This shift in consumer behavior has prompted many organizations to embrace carbon accounting as a means of showcasing their environmental responsibility. For example, a clothing brand that meticulously tracks its carbon emissions can transparently communicate its sustainability efforts to consumers. By sharing this information, the brand builds trust and loyalty among its customer base, ultimately driving sales and fostering a positive corporate image. In addition to benefiting individual companies, carbon accounting contributes to a broader understanding of emissions at the national and global levels. Governments and international organizations rely on accurate carbon data to formulate effective climate policies and agreements. The Paris Agreement, for instance, hinges on countries committing to specific emissions reduction targets. Carbon accounting provides the necessary framework for countries to measure progress toward these goals. When nations report their emissions transparently, it fosters accountability and encourages collective action against climate change. Countries that excel in carbon accounting can even position themselves as leaders in the global market for sustainable technologies and practices, thereby stimulating economic growth. The impact of carbon accounting extends beyond corporate and governmental realms. It also influences investment decisions. Investors are increasingly seeking out environmentally responsible companies, often referred to as ESG, environmental, social, governance, investors. These investors are more likely to support businesses that demonstrate a commitment to reducing carbon emissions and enhancing sustainability. A company that actively engages in carbon accounting can attract investment by showcasing its proactive approach to environmental responsibility. This influx of capital can then be reinvested into sustainable practices, creating a virtuous cycle of economic growth and environmental stewardship. Furthermore, carbon accounting can drive innovation. As companies seek to reduce their emissions, they are often compelled to explore new technologies and practices. For example, the rise of renewable energy sources, such as solar and wind power, can be traced back to the urgent need to lower carbon emissions. Businesses that prioritize carbon accounting are more likely to invest in research and development, leading to breakthroughs that can benefit both the environment and the economy. This innovation not only helps combat climate change, but also creates new job opportunities and industries, further fueling economic growth. In conclusion, carbon accounting is not just a technical or regulatory requirement. It is a vital instrument in the fight against climate change. By measuring and managing carbon emissions, organizations can enhance sustainability, promote transparency, and drive economic growth. The examples of companies and countries that have embraced carbon accounting illustrate its far-reaching impact on environmental responsibility. As the world grapples with the challenges of climate change, carbon accounting will continue to play a crucial role in shaping a sustainable future for generations to come. Thank you for watching this episode of the Ecopoly Carbon Accounting Masterclass. Every number we track, every footprint we reduce, and every decision we make brings us one step closer to a low-carbon future. Whether you're an individual, a business, or a community leader, your action matters. Stay curious, stay committed, and keep building the world we all deserve. Don't forget to like, share, and subscribe for the next step in your sustainability journey. This is Ecopoly, decoding the climate economy, one story at a time.